listen to me carefully, because what I'm about to tell you may be the last easy money you ever make. Not the last chance to make money, but the last easy one. The kind where you don't need to be a genius. You don't need to time anything perfectly. You just need to see what's coming before everyone else does and position yourself early. I have lived through several of these moments in my life. I saw one in the 1970s. I saw another one in 2008. And I am telling you plainly, without the pipe, that we are sitting at the edge of another one right now. Most people will miss it, not because they're not smart, because they're staring at their phones, watching the same handful of exciting stocks everyone else is watching, while the real opportunity sits quietly in plain sight, unloved, misunderstood, and cheap. I want to walk you through exactly what I see, exactly why I believe it, and exactly what I would do if I were you. Stay with me for the next 30 minutes. It will change how you think about money for the rest of your life. Before I go any further, I need to ask you for something small. If this video helps you, if even one idea in here changes how you protect your savings, subscribe right now, today, before you forget. I'm not selling you anything. I'm not asking for money. I'm asking for 30 seconds of your time to hit one button. What I'm giving you in this video is the same kind of thinking that took me decades and a lot of painful losses to learn. And honestly, it's worth more than most paid courses out there. You're getting it for free. All I ask in return is that you subscribe. So more of this reaches more people who need it. Let's start with the big picture, because you cannot understand this opportunity without understanding the machine we're all living inside of. I've spent my whole life studying how economies move. And what I've learned is that they move in cycles, big, long cycles that most people never see because they only live through a small piece of one. Think of it like the seasons. You don't need to know exactly when winter starts to know it's coming if you watch the leaves change and feel the air get colder. Economies have their own version of seasons, and the biggest one, the one that matters most right now, is what I call the long-term debt cycle. It plays out over 50, 70, sometimes 100 years. So most people alive today have never lived through the ending of one. And that's exactly why most people get blindsided when it happens. Here's how it works in simple terms. Governments and central banks want growth, so they encourage borrowing. Borrowing feels good at first, because when you borrow, you get to spend more than you earn. And when everyone does that at once, the whole economy looks like it's booming. But debt is not free money. It is spending pulled forward from your future self. And over decades, that debt piles up and up until eventually the interest payments alone become so large that something has to give. When that moment arrives, the people in charge have only a few real choices. They can raise taxes and cut spending, which is painful and unpopular. They can let people default, which causes panic, or, and this is what they almost always choose, they can print more money to cover the gap. Printing money feels painless in the short run. Nobody has to vote for it. Nobody feels the pain immediately, but it quietly steals value from every dollar, euro, or pound sitting in your bank account. Because when you create more units of a currency without creating more real value, each unit is worth less. I want you to sit with that for a second, because it is the single most important idea in this entire video. The money in your savings account is not a safe place to store your wealth during this part of the cycle. It feels safe because the number on the screen doesn't go down, but the number staying the same while prices around you rise is not safe. It is a slow leak. I've watched this happen again and again across different countries and different centuries, and the pattern rhymes every single time, even though the details change. Right now, look at the numbers. Government debt relative to the size of the economy in the United States and in most developed nations is at levels we've only seen a handful of times in history, usually right before or right after a major war. Interest payments on that debt are eating up a bigger and bigger share of government budgets every year. And the people running these countries have shown you exactly what they'll do about it, because they've already started doing it. They are printing. Now, why does this matter for you and your wealth? Because when a country reaches this stage of the cycle, the value of its currency and of anything priced in that currency and not backed by real productive value tends to get squeezed. Bonds get squeezed because the fixed payments you're promised buy less and less. Cash gets squeezed for the same reason. And the wild speculative parts of the stock market, the parts most people are piling into right now, chasing the newest exciting story, tend to get hit hardest of all when the mood shifts, because their prices were never really about real earnings in the first place. They were about excitement and hope. When the excitement fades, and it always fades eventually, that money doesn't just sit still. It has to go somewhere. And understanding where it goes is the whole secret to this opportunity. I've spent years building what I call a template for how these cycles typically unfold by studying case after case, country after country, going back centuries. And what strikes me every time is how similar human behavior is at each stage. Even though the specific technology or the specific headlines change completely, early in the cycle, borrowing feels responsible, almost virtuous, because it's funding real growth, real factories, real innovation. In the middle of the cycle, borrowing starts funding speculation instead of production, and people stop noticing the difference because asset prices are still going up either way. By the late stage, which is where I believe we are now, debt has grown so large relative to income that servicing it becomes the central problem policymakers have to solve. Whether they admit it publicly or not, every tool they reach for from that point forward is some version of the same trick taken from savers, quietly, gradually, in a way most people never quite notice, until they add up the damage years later. So let's talk about why paper money, and I mean this broadly, cash, bonds, anything that is just a promise printed on paper or stored as a number in a bank's computer, becomes the trap at this stage of the cycle. Paper money only holds its value if the people creating it are disciplined throughout history. And I've studied hundreds of years of this across dozens of countries. The people in charge of money almost never stay disciplined. Once debts get large enough, it's not because they're evil or stupid. It's because the alternative, real austerity, real pain, real belt tightening, is politically almost impossible. No leader wants to be the one who tells people their pensions are being cut or their taxes are going up sharply. So instead, they choose the quiet path. They print They call it stimulus or quantitative easing or any number of technical sounding names, but the effect is always the same. More units chasing the same amount of real stuff in the world means each unit buys less. Think about what a dollar could buy you 50 years ago compared to today. A house, a car, a meal out, all of it cost a small fraction of what it costs now. Some of that is because the economy grew and got more productive, which is good and real, but a huge chunk of it is simply because there are vastly more dollars in existence chasing the same houses, the same cars, the same land. That is the quiet tax nobody votes for. It doesn't show up on your paycheck stub. It shows up slowly in the gap between what your savings could buy you last year and what they can buy you today. And here's the part that should really get your attention. That gap tends to widen fastest, not gradually, but in sudden bursts, right around the turning points of these long debt cycles. We may be approaching one of those turning points right now. I know this can sound alarming, and I don't want you to panic because panic leads to bad decisions. What I want instead is for you to think clearly the way I try to think, which is to look at what has actually happened across history in similar moments and use that as a guide rather than guessing or hoping. So let's look at what history actually teaches us, because this is not the first time humanity has stood at this exact crossroads, and it will not be the last. Go back to the 1970s. The world had come off a period where money was loosely tied to gold, and then that tie was broken completely. In 1971, governments were free to print without that old constraint. Inflation took off. Stocks that felt exciting in the years before, the flashy growth names of that era, got crushed in real terms, even though many of their prices looked fine on paper, because inflation quietly ate away the real value underneath. Meanwhile, hard, tangible, productive assets did something very different. Gold went from around $35 an ounce to over $800 an ounce within that decade. Real estate held its value far better than paper assets. Commodities, the actual physical stuff the world needs to function, oil, grain, metals, all surged, stayed, because their value was tied to something real, not to a promise from a government. Now go back further to the 1930s and 40s, a different kind of debt crisis, but the same underlying pattern. Countries devalued their currencies. Gold was revalued sharply higher relative to paper money. Productive hard assets, land, businesses that made real things people needed, held up far better than cash or bonds. And jump forward to 2008, I lived through this one very closely. It shaped a lot of how I think about markets today. When the financial system nearly collapsed, the response from central banks around the world was the same. Playbook, print, support the system, flood it with liquidity. And in the years that followed, gold roughly tripled from its pre-crisis lows. Real, productive assets around the world quietly rewarded the people who understood what was happening, while a lot of everyday savers who kept their money in cash because it felt safe watched their purchasing power erode. I'm not telling you this to scare you. I'm telling you this because the pattern is remarkably consistent, and because right now in 2026, we are looking at almost every single ingredient of those past moments lining up again at the same time at a scale we haven't seen before. debt levels higher than in the 70s, central banks that have shown repeatedly that their instinct is to print rather than to inflict pain. A speculative frenzy in a small number of exciting stocks reminds me, honestly, of the excitement I saw around technology stocks right before the dot-com crash and right before other bubbles throughout history that I've studied. History doesn't repeat exactly, but it rhymes. And right now, it's rhyming loudly. There's one more piece of history worth mentioning because it's less well known, but just as important. Go back to the years after World War II, when many countries came out of the conflict carrying enormous debt loads, larger relative to their economies than almost anything we'd seen before. Governments didn't default outright. Instead, they used a combination of controlled interest rates, financial regulation that forced institutions to hold government debt, and steady inflation to slowly shrink the real burden of what they owed over about 2 decades. It worked in the sense that the debt problem eventually disappeared, but it worked by quietly transferring wealth from savers and bondholders to the government year after year in amounts small enough that nobody rioted over any single year, but large enough that by the end, a huge chunk of real wealth had simply been transferred away from the people who trusted paper promises. I believe something similar is the most likely path forward again today, and I think it's already begun. So here is the actual opportunity. The thing I believe is the last easy wealth-building move available to ordinary people for what could be decades. It is not a hot stock tip. It is not some secret coin. It is something much simpler and much more boring, which is exactly why most people overlook it. The opportunity is to shift a meaningful portion of your wealth out of paper promises and into real, productive, hard assets before the crowd figures out they need to do the same thing. When I say real, productive, hard assets, I mean things that have intrinsic value regardless of what any government decides to do with the printing press. Gold is the classic example, and I still believe in it, because for thousands of years, across every culture on Earth, gold has held value. When paper money failed, it's not exciting. It doesn't pay you a dividend, but it doesn't need a government's promise to be worth something either. And that is precisely the point. But I want to push you beyond just gold, because gold alone is not enough. Think about productive, real assets too. Businesses that own the actual physical infrastructure. The world cannot function without farmland that grows the food people must eat no matter what happens to interest rates, energy infrastructure that powers homes and factories regardless of which political party is in charge, toll roads, ports, pipelines, the unglamorous backbone of the real economy that keeps collecting value no matter how loudly the stock market screams about the latest exciting technology story. These assets share one quality that makes them so powerful right now. Their value is tied to something the world physically needs, not to a story, not to a promise, not to a number a central bank decides to create out of thin air. When currencies get debased, these are the assets that tend to hold and often grow their real value, because you can't print more farmland, you can't print more gold, and you can't print a second copy of a 100-year-old energy pipeline. I also want you to understand why I call this the last easy opportunity, because that word easily matters, and I use it carefully. Right now, most of these assets are cheap and unloved, precisely because everyone's attention is somewhere else. chasing the next exciting story. That is exactly the environment in which the best long-term opportunities appear. When something valuable is being ignored simply because it isn't exciting, once the shift happens, once the broader world wakes up to what's occurring with debt and currencies, the money that floods into real assets will not trickle in, it will pour in, and prices will move quickly. The easy part, the part where you can still buy quality real assets at reasonable prices without fighting a crowd, is happening right now while most people are distracted. Once that window closes, and it will close, the same opportunity becomes much harder and much more expensive to capture. That's the difference between buying early and buying late. And it's the difference between a truly life-changing outcome and a mediocre one. Now let's talk about how to actually do this, because understanding the idea is worthless without a sensible way to act on it. I want to give you the same principles I try to apply to my own decisions, because they are simple, even if they're not always easy to follow with discipline. First, diversify across several of these real assets rather than betting everything on just one. Gold protects you in some environments, productive land and infrastructure protect you in others, and no single asset is guaranteed to be the best performer in every version of how this plays out. Spreading your exposure across several uncorrelated real assets reduces your risk while keeping you positioned for the broader shift. Second, move gradually, not all at once. Nobody, including me, can perfectly time the exact top of a cycle or the exact bottom of another. Build your position over months, buying in pieces, so that if prices dip further before they rise, you're still buying at a reasonable average. And if they rise faster than expected, you're not left completely on the sidelines. Third, think in terms of years, not weeks. This is not a trade you check every single day. The long-term debt cycle plays out over years, sometimes even a decade from the first cracks to the full resolution. And the people who benefit most are the ones patient enough to hold through the noise in between. Fourth, keep enough in truly liquid, stable reserves to cover your near-term needs. Because being right about the big picture doesn't help you if you're forced to sell your real assets at a bad moment because you needed cash for an emergency. And fifth, and this might be the most important principle of all, understand what you own and why you own it. If you know you hold gold and productive real assets because you understand the debt cycle and the risk of currency debasement, you won't panic and sell at exactly the wrong moment when a scary headline hits. Conviction built on understanding is the only kind of conviction that survives a real storm. I want to be honest with you about the risks too, because I never want to oversell anything to you. Real assets can still go through periods where they underperform, sometimes for years at a time, especially if governments manage to delay the reckoning longer than expected through clever policy or unexpected growth. Gold pays you no income while you wait. Real assets like farmland and infrastructure can be harder to access directly for an everyday investor, though there are now simpler ways to get exposure than there used to be, and nothing in economics, including everything I've told you today, is ever guaranteed. I'm giving you a framework built on decades of studying these patterns, not a certainty. You have to weigh this against your own situation, your own timeline, and your own comfort with risk, and make the decision that's right for you. But here is what I know for certain. After a lifetime of watching these cycles turn, The people who come out ahead are never the ones who wait until the crisis is obvious to everyone on the news. By the time it's obvious, the easy money has already been made by the people who positioned themselves early while it still looked boring, while it still looked unnecessary, while everyone else was distracted by something shinier. I believe we are in one of those quiet windows right now. I believe the next several years will separate the people who understood this from the people who didn't. And I believe you now have the same framework I used to think about. So here's my challenge to you. Don't just watch this video and move on to the next one. Take one real step this week. Go look at how much of your own wealth is sitting in cash or paper promises right now, and ask yourself honestly whether that allocation makes sense given everything we just walked through. You don't need to move everything overnight, and you shouldn't, but start the process of understanding. Start building your own position gradually, and start thinking in terms of decades instead of days. Share this with someone you care about who's been chasing the exciting stories and ignoring the boring, real ones, because they deserve to see this too. Subscribe if you haven't already, because I'll keep breaking down exactly how I'm thinking about this shift as it unfolds. The world is changing in ways most people won't understand until it's too late. You don't have to be one of them. I wish you all the best.